December 12th. I skied for the first time today for the season. And here in Steamboat Springs, glorious conditions, but don't tell anyone because there was no one on the slopes. I mean, most of the time I skied today, and I didn't have a lot of time. I had an hour, but I could do, I started slow, 10,000 vertical feet, 16 runs in that 1 hour because there's nobody out there. Most of the time I was the only person on the slope. But that'll end. That's the crowd begins to show up next week, I think. Anyway, this is the Market Structure Edge live demo and discussion. I'm Tim Quast. With me is Brian Wilson. And our aim is in the next about 35 minutes to give you helpful pointers. That's the whole objective here. Dan Eisenberg, I see you. Welcome. How are things in Florida? Hope all's good. Okay. Okay, so I've got 4 items I want to cover. I'm going to share my screen here. Bear with me one moment. And I have it while I'm doing that, while I'm waiting for my app to launch. I made a typo, and you probably all saw it and hopefully you knew what I meant. In my note on Monday, I had the market desk notes on Monday and Tuesday, and I said that the S&P 500 was up 16% since November 4th. I meant 6. I think it's about 7 now. I flat missed it. I try to make sure to vet that, but in case you thought I didn't know what I was talking about, it was a typo. I apologize for that. The next thing on my list, the core are 3 things here. And as I mentioned, Benham, I'm going to come to one of yours, which is, we talk a lot about the daily trading ideas, and you observed, do we have reality telling us how to use the data, or are we trying to? You didn't say it this way. I'm paraphrasing. Are we just using the data to try to dictate to reality? And certainly we try to learn from reality. As I mentioned to you, we started, and Brian's been with us a long time. We had more than 10 years of practical application of these data, helping public companies navigate the equity market before we ever said, okay, can we take that data and turn it into something that is a good quantitative market structure tool? By the way, this is still the only one. I'm sure that behind proprietary trading firms, what would I call battlements, their protection of their IP, that they're doing market structure related things. But there is no other decision support platform that is predicated on the rules and the mechanics of the market from the standpoint that we measure trade execution data, we translate it into the demographics, the behavior of the market, and then we calculate demand and supply imbalances out of that. So, it's still new. Very new from a trading standpoint, but it came with a good pedigree of practical application. Here's the point, though. So we concentrate on daily trading ideas, but it's not by any means the only way you can use the platform. Benham, you noted Apple. You said, well, how come, Apple has just been on an absolute tear. Why doesn't it make the momentum portfolio? I mean, you look at this data and you think, well, it's really been tremendous. It's an extraordinary run for Apple. And the answer is the momentum portfolio, whether it's in the daily trading ideas version of it, where we're only going to include the ones from the momentum portfolio that have at least a 51% calculated probability of a 2% or greater return in 1 to 5 days. So the numbers don't always match. There could routinely be fewer in the daily trading ideas version, but it's got 10 or 12 criteria. And so unless you hit all 10 or 12 criteria, whatever it is, I could go look at it specifically, it's not going to, a stock isn't going to show up in that portfolio. So Number one, it's got to be between 8 and 10. And there has to be a 1 day and 5 day downtrend on the supply side. It's why I always say supply is the lesser of the two measures. Demand trumps supply because Apple has, fairly high supply here. Crossed over 50% December 2nd, and yet the price continued to rise. So this does not mean, higher supply, short volume, the SHO Rule 201 data set that says this volume is borrowed and or created by market makers. That doesn't mean the price is going to stop rising. I don't prefer it. Mathematically, when we studied the data, we found underperformance in stocks that had greater than 50% short volume versus a comparable condition where it was below that. So that's the reason we do it. But it's not clearly. Apple could do just fine. And if you want to trade things that you prefer to choose, like Apple, I would, my suggestion is use demand and supply to know why it's doing what it's doing, all other things being equal, and when those conditions are likely to change. I mean, Apple certainly took off when demand and supply diverged at about 5. Apple wasn't doing anything in here. Why did it suddenly take off? Well, demand got back to 5, and there was a great supply deficiency here. So right here is a divergence.
Hey Tim, can you share your screen with everyone, please?
Oh, you're not seeing it. I never finished that step, did I? Thank you for telling me. I didn't realize I hadn't clicked the last button in the sequence. Okay, so here's what I'm looking at. Here's Apple, and what I'm saying is there's a lot of supply in Apple. It's over, it's over 50%, 55%, ticked down yesterday just a little bit. But here was here's where Apple was not doing anything. We have the election bump, but then big tech didn't really participate in that. But look at this: supply deficiency, rising demand. That's where your entry point is. Apple is very good at 5. That many stocks are, rather than 10 with declining supply, the Hicks rule. Great, very high probability chance of producing short-term returns when those conditions exist. For Apple, so long as it's at 5 or better, it tends to do very well. When it drops below 5, tends not to. It's not linear, but if you were going to deploy your capital in Apple, it wouldn't have produced much for you in here. It would be far better to say, oh, it just returned to 5 and supply is way down here at 32, 33%. Well, that's very low, and you could go back and look at it over time, just expand out using this feature up here. You can, go look at any range. You could do a custom range and look at it. But would you stay in it? For me, it's a tough call. When you're at 55% short volume, I would be very inclined to take the gains and go look for something else. But demand has not faltered at all. So your other choice would be, okay, so long as demand continues to be strong and above 5, why would I leave, particularly in a long-term portfolio where I don't mind some fluctuation in the outcomes? I might very well stay unless and until it drops below 5. Then I'm out, and I'll wait for it to return to 5. It's a different way to use the data, but you could do this with anything. You could go create a portfolio that says, for instance, maybe I want to isolate I want large caps because I can get in and out of them, and maybe that's what I'll do. I'm going to take large caps. Oops. And I'm going to look for market structure sentiment, the demand that is greater or equal to 5. I hope I got that right. And I want a trend that is up because I want to buy rising demand, let's just say. And maybe I want a downtrend in supply. You don't have to. I mean, it's not, it's not necessary per se, equal to down. And that rule, then I can, it's just a way to say, okay, I could create a portfolio this way. And whenever something drops out of this list, so that gave me 15, tells you. I mean, This is how difficult it is to build a great portfolio if you're BlackRock, Vanguard, or State Street. It's very difficult to get high quality securities in large numbers. We find it too because we have tools where we can build portfolios quantitatively using these same criteria and run performance data. You know, what happens if you have stocks that are at the low volatility portfolio over the entire year? How would that perform? Or the momentum portfolio over the entire year? How would that perform? So this is my point. You can use it in a lot of ways. And then if something dropped out of here, say this becomes your portfolio, and when something drops off, you remove it and you replace it with whatever manifests the next day. Just saying, there are different ways that you could use these daily trading ideas. To me, that's the easy button. Like, you don't have to do any thinking. You could very easily use that set of criteria to take the thinking out of it. And that's point number two, the mechanics. So I said in Monday or Tuesday, I said I wanted to give you a quick lesson in, to me, volatility, time, and risk. Core things to me to using the data effectively. So if I were going to pick something today, let's say, I like lower priced stocks above 10. I don't want to deteriorate my probabilities, and stocks that are below 10 have a propensity to show greater standard deviation. But let's say I pick American Airlines because it's got a 92% probability. Past performance is no guarantee of future outcomes. It's got 5% volatility. The entry range is going to be somewhere between 1714 and 1790. Again, it's not perfect, but what we're trying to do is make it very easy for you to use the data for a high probability return. And so, if we click through here and look at the data, here's the reason why the probabilities are good. It's at, it already jumped up, but it's at 10 and supply has fallen. See the supply side here? So if demand stays the same, the presence of insufficient supply probably boosts the price. And so then if you go look at it, I don't know what it's doing today, but let's just suppose that this gives us an entry point today. I looked at it earlier. Okay, so it's down, 1.5%. So, well, that's in the entry range. And statistically, does it really matter? Well, you don't want to buy it above the entry range because the probability that you can make 2% diminishes because it's got 5% volatility. So let's say I'm gonna look at this toward the end of the day. Time. The more time you are exposed to position, the greater the risk. But we want to balance that against the fact that high frequency traders have very, very short time frames, fractions of seconds, the least possible risk, but far better data and much more speed. So they will know if the demand supply equation is changing in fractions of a second. I don't want to compete with that. So that's why I'm not a day trader per se, right? So, but I know that they start over tomorrow. So say that this continues and near the end of the day, 3:30 Eastern time, 3:50 Eastern time, that's a great time to me. One buys this. So now, how do you protect yourself? How much should you expect that this would move? Because you don't want to be stopped out. Well, there's 5% volatility. The S&P 500 has 2.3% volatility in its components. SPY has volatility right now of 0.5%, 50 basis points. Usually it's 1. It's why I think the market's, there are challenges to the market. But if I look at this just very practically, I've got to take 2.5% risk. So, what would that be? Well, 2.5%, 45 cents. So if I bought it at 1732, my stop is going to be 45 cents below that. I'm not saying you have to be that precise, but I'm willing to take a 2.5% risk because I know it moves 5%. It's already moved 1.5%. The probability that it moves an additional 2.5% is small, but it's possible. In the probability that the supply demand equation tomorrow, when everybody starts over again, gives me 2% or more. That's all I'm after. And that's how you could do it. It won't work 68% of the time, statistically. That means if you get stopped out, don't worry about it. Don't rue that. Don't just do something else. Which leads me to the third item. trading volatility. When we know what volatility is, there are opportunities like now. I mean, all this week you could make 2 to 4% every single day trading a short. So one day it didn't work, right? So it's always, again, statistics, right? Trading, say, SPXU, trading SPXU, and but you could pick anything, and a volatility trade like UVXY. I mean, today you could do that every single day and take small gains once you have them, and you could follow the same principle. By late in the day, the market moves. It moves outside market hours. There have been some important data that have contributed to that. But then it has a propensity to the downside, and then it recovers. All of that has to do with, by the way, ETFs and a basket of stocks. Things tend to mean revert throughout the day because market makers are trading more ETFs than underlying stocks, 2-to-1 ratio, basically, in the US equity market. And so there will be mean reversion, but we know that the supply-demand balance isn't great. If you look at the broad market, this is the broad market. The demand side is deteriorating. The supply side is fine, but it has bottomed and risen a little bit. Do these things portend big moves? Not necessarily. But they certainly tell us that the bias, and it's been true in the whole market, you see the benchmarks have done fine, but the whole market isn't awesome. I think we've had 5 straight days of, if you added it up, net selling in the S&P 500. And I think if you took the average stock in the S&P 500, it's down about, call it 2%, close to that over the last would that be 2 weeks, Brian? I think, 2.4% over the last 2 weeks. So it's had a little, if not the entire 2-week period, but those are the real conditions. So it makes it possible when demand is falling and supply is rising to trade time volatility and when you're aware of risk. Those are the things I use all the time. And it's, the only reason I can do it is by knowing the supply and demand equation in the whole market. Okay, I'm going to pause. In fact, Brian, that's what I have to cover. So
Okay.
I will hand the baton to you, but I can certainly answer some questions.
Yeah, one question for you, Tim. Joe asked what volatility measure that you use for UVXY.
Joe, I think I owe you an email too, and I haven't forgotten about you. I've got you flagged. What measure I use for volatility?
So like for SPY recently, it's been 50 basis points. Do you have like a bogey for UVXY where you're looking at a certain percentage?
You mean how much it moves? Is that what we're
Correct.
after? Yeah,
I think so.
Again, I'm after 2%, and it's moved more than that. Okay, how do you plan your entry? I don't. I just buy it. I don't plan that at all because where it closes is unlikely to be where it is tomorrow. And I don't really care, right? I know what the bias in the market is. The bias is to the downside. I still might hedge myself. And, if you're worried about that, what you do is you buy, I'm just making it up. So, what I tend to trade is, it's $25,000 to $50,000 of UVXY, something in that range. And then I might hedge with 10 to 15,000 long short, something like that. Right? So it's somewhere in that range. And right now, I'm not even really hedging against an upside move. Cost me on the day when the CPI data came out. There's no logical reason for the market to rise sharply like that on the inflation print that we got. But whatever, you could hedge yourself. Where you say, okay, in case the market moves against me, have a long position, SPXL. I'm not endorsing those products. I'm saying they're very liquid and easy to get in and out of. And you have a very small position in that. You know that the overall bias is down in the market, SPXU, and then your real gain is in UVXY, which moves no matter what the market does. But you have to take the gain. So if it moves 2 or 3%, take it and be done with it, because it will deteriorate as time progresses, right? That's the problem. You can look and you're up $2,000-$3,000, and you look away and you come back and you're up $500, right? It just disappears like that. So you can't you can't hang around. And the only time that these conditions, these trades work well, I think we've had kind of an extended period here, been more frequent than usual, is because demand and supply in the broad market are converging, however slowly. And big tech's doing the opposite. Big tech is screaming. It's 9.6, that portfolio. I think Brian Wilson pointed that out. So this causes distortions in the market that we can profit on because we know that these things create volatility. Okay, well, let's try to capture that, taking very little risk. And the only reason we know that we can do this is because, again, of the supply-demand balances that we can see. Okay, over to you, Brian.
One add-on question from Benham, Tim, if you don't mind addressing that.
Sure. Okay, so let's see. Okay, let me see. Okay, let's see. Tim, at profit or stop loss, you liquidate all the UVXPX. Good question. So if the only exception to this might be that if I have had a good move in the short hedge, SPXU, and in volatility, get rid of those one right after the other. And I might keep the long hedge because the market has a propensity to mean revert. So, right, if the market moved down, like today it moved, you could watch those broad measures move. And what's I'm trying to pick out where the Dow is at the moment. But my point is, if the market's down 85 basis points, whatever your measure, what's the probability it reverts to only down 30? Well, knowing what the volatility trends are, pretty high. So I might hang on to my SPXL, and if I get some gain out of that thing, then I'll sell that. But generally, I'm leaving them. Yeah.
Perfect. Thank you very much. And feel free to add questions to the chat line as you think of them. I'll pick up a couple of topics, and then Tim and I can probably kind of address the road ahead. I think I've done this exercise maybe once or twice. Coming up on a big week next week, I thought it was a good time to revisit this topic. I won't spend a lot of time on it, but it's just a way to look at the world. This was the world that everyone was used to back in the mid 90s. This was the world that Tim was used to as an IR professional. It was the world that I was used to as a buy-side trader. This is the world today. Most executives at public companies have no knowledge of this. You're one of the few in the nation that have an inkling that the world has changed. Here's the point for next week. There's going to be a lot of movement on the passive investment side. Coming up on options expirations, passive money, big users of derivatives instruments. And at the end of next week, we also have the S&P index rebalances. One other way to look at this data, each behavior has different reasons why they're buying or selling. Active money cares about the actual stock story. They care about fundamentals, but that's only about 10% of the time. Passive money cares because there's some characteristics, whether that's large cap, whether it's volatility, whether it's sector, whether it's factor characteristics. There's some type of characteristic why a certain stock is in a certain model. Fast traders, of course, just care about price differences. They're making markets. They're trying to ride pricing trends. A lot of times they're doing this a quarter penny at a time, tenth of a penny at a time, and just doing that over and over again. And then, of course, the risk management side, looking at the use of derivatives, leveraging or protecting with derivatives, and think about options, forwards, futures, just some examples there. But it's good for you to know, what are the reasons that investors and traders buy or sell, because they do differ. They're very different for an active investor versus a fast trader. Fast traders don't care about the stock story. They don't know anything about it. It's just a number on a screen, and they're just trying to profit over time and trying to get flat by the end of the day. So I just wanted to bring bring up those behaviors. It had been a little while since we had looked at that. Let me move over to my portfolio. And I just wanted to walk you briefly, and Tim kind of alluded to part of this. It's difficult to find anything with much strength other than big tech right now. I've got a number of different portfolios here, but the FANG stocks are up. That's basically big tech. Look at large cap trending down, Magnificent Seven, big tech trending up, mega cap, demand is trending down. As we go through this exercise, small cap down, stocks down, pretty much everything is going down right now. We look at some of the sectors, communication services, consumer discretionary, consumer staples. We're making kind of a clean sweep here as we go through. Energy down below, down to 3.5, so very weak. Financials down below neutral as well. So you get the point that we're definitely at a little bit of an inflection point as we approach expirations next week. Now I'm going to go out on a limb for a second here, and I'll show you something, but this is very, very speculative. So just take it for what it is. I've been just watching this here over the last few months. And my thesis, and like I said, I don't know if it's true or not. So I'm sharing an unfounded thesis. I'll do this once in a while, as long as you know that I haven't tested it. But here's my thesis. Over time, this SPY weightings, different sectors, and you can see everything kind of trends along at a certain point. Notice what's happening in a couple of these sectors. We've had tremendous strength in communication services, consumer discretionary. Look at those weightings that are going up over time. Look at information tech that's going up over time. My thesis, I could be wrong, is that I think some of this is going to be overweight next week as we come to the S&P index rebalances. So just tuck it away, maybe watch it along with me, see if my thesis proves true or not. Like I said, it's unfounded, but it's something that I'm just kind of watching right now. Let me shift over to broad market sentiment. Tim mentioned this already, and I'll take this look back year to date. What we saw recently with this move, and I mentioned it in the market desk note this morning, this was almost exactly what we normally see. Over the last 5 years, when we move red line to red line, the market averages 50 basis points of gains, and we tend to be above the red line for 9 days before we move back below it. This time, I think it was 7 days. And I think market returns were 59 basis points. I'm going off of memory, but very, very similar to what we normally see. Tim and I were discussing this move this morning. It is an outlier. We've been talking about it here on the demos over the last few weeks. We had a little bit of a reason ahead of the election, perhaps why short volume had moved lower. I think market participants were speculating on a certain outcome. Of course, we saw the huge gains afterwards. I really thought that this trend higher would continue. In other words, kind of a mean reversion back to the norm. And as you can see, it hasn't. Those short volumes do remain very, very low. At face value for now, I have to take it as a bullish indicator that market participants continue to be bullish in their overall outlook at this particular time. Now we'll have to watch this through options expirations next week, and then as we approach year end, and I think we talked about this last time. As we get to January trading, just be aware in January during the last 3 years, it's really set the tone for the rest of the year. Look at January 2021. We immediately move lower from that point going forward. If we fast forward to January 2023. We were immediately higher, really set the tone going forward. And then January 24, once again, moving higher. Now it's the last 3 years. It is what it is, but for 3 years in a row, that January timeframe has really set the tone. So I'll be watching, it's a couple weeks away, but watching January trading and watching this short volume trend. Like I said, for now, I have to treat it as bullish. And I think, I'm not surprised by today's, market, I'll call it divot, move lower. But I also wouldn't be surprised if we slowly kind of grind higher, as we kind of move into that year-end time frame. I think that's everything I wanted to share, Tim, and feel free to jump on in.
Okay. Thank you very much, Brian. Appreciate that. Well done. Yeah, I think we'll just, in the last couple of minutes, talk quickly about, you've already sort of done it. What happens next? I mean, we're always thinking about that, but in fairly short increments. We've mentioned this before, but if you're new, our data are very accurate in 5-day increments. And we behind the scenes, we run what we call market structure bands versus everything. And over a year's comparison period with the SPY, our 5-day forecasts using market structure bands are 99% correlated to the SPY. So it tells us that in the short term, we're very, very effective at forecasting where prices will go. You get beyond 5 days, there's dramatic deterioration because patterns change, behavior of money changes. There are events that affect behavior. There's enormous betting that occurs directionally in the market. In fact, it's one of my, I can't prove this. It is it is purely speculative, and I don't have data that would back it up. So with those heavy qualifiers, I would say that the part of the reason we are seeing these almost historical low levels of short volume, and again, it doesn't seem like it to someone. If you look at it and say, well, the market is 45% short, meaning if you take the volume in the marketplace, 45% of it is borrowed or created, and 55% of it is long, coming from people who own it. That's what that means. But over the last number of years, it's been very close to 50-50. Which is exactly where hedge funds like Citadel, the hedge fund side of that operation, not the market making arm, like to run their portfolios. We know those people very well. And they tend to run 50% long, 50% short, and they're trying to profit on volatility, how prices change. Then they have no risk. They move one side or the other a little bit, and they take gains. Their time frames are longer. But it's an effective way to approach the market. Now, so at 45%, my thesis is that this in part reflects something that we're observing in the data. I just had a meeting with our chief data engineer, and we were looking at the characteristics of public companies and moving into the number 5 and number 6 position in stocks like Microsoft, Apple, Nvidia, Campbell's Soup, Accenture. We have just ones that we were looking at are volatility hedged ETFs and synthetic long short ETFs, and it reflects what we do. So, if I'm trading leveraged instruments, how are those things constructed? Well, a bank, let's say Citi sells a total return swap to Direction or whoever is constituting that ETF. Direction pays Citi a fee, and Citi gets access to a portfolio at 2 or 3 times the return. Somebody owns that and is providing access to it also for a fee. Then there is a hedge, right? So Citi's going to hedge its exposure in some fashion by being long or short. And if there is an overweighted long hedge in the market, what will happen to short volume? It will decline materially. And I think that is absolutely what is happening. As these instruments become 20% of the market, it can cause significant changes. The problem is, and this is what I look for, it's also why I have at this moment the only significant longer range bear bet. It's not because I think the market's great. I'm a capitalist. I'm very happy with the incoming administration's focus on good business practices, being pro-business. Those are, to me, beneficial things economically. But the market is at risk of being too heavily levered long. And if something goes wrong, everybody will run to the other side of the boat and the boat tips over. I'm not saying it's going to happen, but it's for the one of the very rare times to me that I think that risk exists very significantly here. And I may very well be wrong. I'm not saying that will be correct about that, but the reason that I conclude it is I can understand why short volume is abnormally low. The spreads have dropped dramatically in the instrument, like ETFs and the baskets they're supposed to track. Well, it gets very difficult for market makers who are trying to. There are over 3,500 ETFs traded in the US market, and there are only, call it 30 firms that are principally responsible for supporting all of those. They're the very same firms that support the treasury market, that are the primary dealers for the Fed. They're the same firms executing all the customer orders for BlackRock, Vanguard, and State Street. So they're doing all this stuff. And as spreads come down, they have to choose. Well, what are you going to do? Well, you can't stop being a primary dealer. That's your number one responsibility. Could you stop making markets in some ETFs? Well, yeah. Which ones would you do that in? I don't know, but I look at that and say it gives me the creepy crawlies about the risk in the market here. And it would really catch people out because no one's expecting it. Yeah, I could be guilty of confirmation bias. If I make an argument, I am necessarily biased toward its rectitude. And it might be wrong, but I do think that is contributing to these very low levels of short volume. And at some point, Herb Stein's law, if something cannot last forever, it will stop. So we'll see. I just don't know. But you people smarter than me, Barry Norton, what do you think? You're still muted, Barry.
There we go. So I call it reading the market structure tea leaves. And I think there's some credence to what you say. I've been using the negative momentum portfolio against the regular momentum portfolio, right?
Yep.
And then I also watch Brian's negative portfolio.
Yep.
Our portfolios differ because I capture a higher level of demand than he does. I'm at 9, he's at 4. But what's interesting is, a few days ago, you had over 20 components in the momentum portfolio and only 3 in my negative. And then one day, Brian's was actually 0, right?
Yep.
And you look at where broad market sentiment is at, you begin to see these things. But the first thing I notice ahead of broad market sentiment is a reversion. So right now, momentum is at 15 and the negative is at 14. So they're balanced, but negative momentum is gaining ground.
Yep.
And so when you look at that, that's the first thing I look at is where are those two portfolios at? And then I go see, okay, am I seeing that in the other portfolios? Yep. And I can even look at the components inside of the negative momentum portfolio and see how that jives against the positive portfolio to see, is there rotation? Yep. And when I see that you have similar components in both, okay, that tells me there's some rotation. But when you see the higher caps ending up in the negative momentum, you can begin to see that, there is some volatility ahead and it may not be to the upside.
Yep. Yeah, that's a great description. Yeah. Thank you, Barry. That's well said. So what Barry does is inverse the momentum portfolio in effect. So that's his long short strategy. Excellent.
And he captures them as they move below 9 from a sentiment perspective. That's what he was describing. And if anyone's interested, just send me an email and I can send you the details on those portfolios.
So, yeah, he's BW at marketstructureedge.com. I'm TQ at marketstructureedge.com. Email us anytime. As Benham knows, it sometimes takes me a few days, but I'll get back to you. Yeah. All right. Good to see everybody. Thank you very much. Have a great weekend.